price can be pushed around. A thinly traded stock can be moved by a single large order. A headline can spike price for an hour before it reverses. Chart patterns can fail. Indicators can give false signals. These things happen constantly. Volume is different. Volume is people voting with real money. When a stock rallies on thin volume, a small number of participants are driving it. When a stock rallies on 3 times its average daily volume, something significant is happening. Enough people with enough conviction that it shows up in the data. Volume is the one input in technical analysis that reflects actual commitment. Every other indicator is derived from price. Volume tells you whether price moves are believed. Let me show you how to use AI to read it properly. Volume gets ignored for a simple reason. It is not intuitive. A spike to twice average volume on a down day means something different from the same spike on an up day. Volume that dries up on a pullback in an uptrend means something different from volume drying up at a top. Context changes the meaning of every volume reading, which is exactly why most retail traders just skip it. There are 3 volume concepts that actually matter for analysis. First, volume relative to average. A spike is only meaningful compared to what is normal for that stock. 1 million shares on a stock that averages 5 million is light. 1 million shares on a stock that averages 200,000 is significant. Second, volume direction. Price up on heavy volume is buying pressure. Price down on heavy volume is selling pressure. The combination of price direction and volume magnitude tells you who is in control. Third, volume trend. Volume declining over time while price holds, even on down days, often signals absorption. The supply is being taken off the market. That is a bullish condition even when price is not moving. AI handles all 3. Prompt 1 identifies the days that actually matter. Pull up your price and volume data, at minimum 3 months of daily OHLCV. Paste it into AI or upload the chart. Use this prompt. Analyze the volume data for this stock over the past 6 months. Identify every day where volume was at least 150% of the 20-day average volume. For each high volume day, tell me the date, whether price closed up or down, the magnitude of the price move, and how price behaved over the following 5 trading days. Then identify which high volume days appear to be institutional buying, which appear to be institutional selling, and which are ambiguous, and explain the reasoning for each classification. High volume days are when institutions move. An institution managing billions of dollars cannot buy a full position in a single day without moving the stock. They accumulate over time, but the footprint shows up in volume. AI can surface that pattern. When AI returns the high volume day analysis, you are looking for 3 things: climactic versus accumulation. A single enormous volume spike, often 5 to 10 times average, on a down day is called a selling climax. It means panicked sellers met a buyer large enough to absorb everything they had. That is a potential bottoming signal. Conversely, a spike on an up day near a breakout often signals accumulation, an institution establishing a position before a move. The context changes the interpretation. Follow through. What happened after the high volume day is more important than the day itself. If price ripped up on huge volume and then spent the next 5 days giving it all back on light volume, the spike was likely a sell the news event. If it ripped and held or consolidated on low volume before continuing, the volume day was the signal, recency. A high volume spike from 8 months ago is historical context. One from 2 weeks ago is live information. Weight the most recent high volume days most heavily in your analysis. Prompt 2 uses unbalanced volume, OBV, which is one of the most underrated tools in technical analysis. OBV works by adding each day's full volume to a running total when price closes up, and subtracting it when price closes down. The result is a cumulative line that reflects the net flow of volume, buying minus selling, over time. Its most important property, OBV often leads price. When OBV is making new highs, while price is still below its previous high, institutional money is flowing in before price confirms. Use this prompt. Calculate the on-balance volume for this stock over the past 6 months, using daily closing prices and volume. Then analyze the relationship between OBV and price. Is OBV confirming the price trend by moving in the same direction, or is there a divergence where OBV is moving opposite to price? If there is a divergence, identify when it started, how large it is relative to prior divergences in the dataset, and what happened to price after similar OBV divergences in the past. Also tell me whether OBV is currently at a new high, new low, or mid-range. OBV divergence from price is a leading indicator. It is not instant. The price can lag the OBV signal by weeks. But when OBV starts making new highs before price breaks out, you are watching smart money accumulate. The OBV analysis gives you 2 signals worth acting on. Confirmation: when price is in an uptrend and OBV is also trending upward, the trend has volume backing it. That is a healthy condition. Institutions are participating. The trend has credibility. Divergence: this is the valuable signal. When price is making new highs, but OBV is not, meaning the net volume flow is not keeping up with the price move. Distribution is happening. Someone is selling into the rally. The price is moving up, but the underlying volume dynamic is deteriorating. This is not a sell signal by itself, but it is a warning. It should reduce confidence in new long entries. The inverse, OBV making new highs before price, is the accumulation signal. Watch for it when price has been in a long downtrend, and suddenly OBV stops making new lows. That divergence from the bottom is one of the best early signals of a reversal that technical analysis produces. Prompt 3 connects volume to the price levels you identified in EP40. The most important volume analysis is not average volume on random days. It is volume at the specific price levels that matter. A support level that held 3 times on heavy volume is a completely different animal than one that held 3 times on thin volume. Use this prompt. Using the key support and resistance levels I identified earlier, list the levels, analyze the volume behavior each time price tested those levels. For each level, tell me how many times price approached it, what the average volume was during those approaches relative to the stock's 20-day average, whether the level held or broke, and what the volume looked like when it held versus when it broke. Also, identify whether any current support or resistance level has been tested recently on declining volume, which often signals the level is weakening, versus tested on expanding volume, which signals it is being defended. A resistance level that gets approached on declining volume is more likely to break than one being sold into aggressively. A support level being held on expanding volume means buyers are committed to defending it. Volume at key levels is the conviction read behind the technical setup. Volume at key levels tells you the quality of those levels, defended levels. When price tests a support level and buyers step in aggressively, volume spikes, price bounces quickly. The level is being actively defended. There are institutional participants who do not want price below that number. That is strong support. Deteriorating levels. When price approaches support and volume dries up, nobody is buying aggressively. It just kind of stops there. The level is holding for now, but the conviction is not there. The next test is more likely to break it. Break out volume. This is the most actionable piece. A breakout through resistance on heavy volume is a genuine breakout. A breakout through resistance on light volume is a false breakout candidate. AI will compare the volume on the breakout day to average volume and give you that ratio. If it is below 1.5 times average, be skeptical. If it is 2 to 3 times average, the breakout has credibility. The bonus move is looking at the overall volume trend, not individual days, but whether volume is structurally rising or declining over time. Use this prompt. Compare the average daily volume for this stock across 3 periods: the first 2 months of the past 6 months, the middle 2 months, and the most recent 2 months. Is overall volume trending up, down, or flat? Then break this analysis into up days versus down days. Is volume heavier on days when price rises or on days when price falls? Calculate the up volume to down volume ratio for each 2-month period and tell me whether institutional participation appears to be increasing or decreasing, and whether that participation is net buying or net selling. The up/down volume ratio is a blunt but effective tool. When up days consistently attract more volume than down days over a sustained period, institutions are accumulating. When the reverse is true, heavy volume on red days, light volume on green days, distribution is occurring even if price is holding up. A stock where price is flat or slightly up, but down volume consistently exceeds up volume is showing you supply overhanging the market. The selling is being absorbed, but slowly. When the absorption ends, price will fall. Volume does not lie because it cannot. It is not a calculation derived from price. It is the raw count of shares changing hands. Prompt 1. Volume spikes. Find the days that mattered. Classify them as accumulation or distribution and study what happened next. Prompt 2. On balance volume. Measure the cumulative net flow of buying versus selling. Divergences between OBV and price are early warnings, both at tops and at bottoms. Prompt 3. Volume at key levels. Assess whether support and resistance levels are being defended with conviction or deteriorating under low participation. Bonus. Volume trend over time. Separate up-day volume from down-day volume and determine whether smart money is net buying or net selling over the medium term. When price and volume tell the same story, the signal is clean. When they diverge, something is about to change. Next episode, moving averages, the simplest tool in technical analysis and the one most traders use wrong. See you Monday.